So I think that the profitability of the bank sector is very good in the U.S. We have had a turmoil with concerns about deposits that have stabilized. We've certainly seen credit costs go up slightly, primarily for reserve building. And then you've had a little bit of squeeze on net interest margin and the top line revenues. That's the bad news. I think expenses have been stable. And I think generally, as the CEOs had mentioned on their interviews today, business trends are actually improving as we finish the quarter and head into third quarter. So I'm bullish from the standpoint the market, I think, overshot the negativity. I think there is still room for the PEs to come back. We're a very low PE relative to the S&P 500. It's a low price to book in the industry. I think capital will continue to form, and I think balance sheet growth is somewhat limited. But by the same token, I think capital ratios will continue to inform. Most of these companies are retaining earnings the second half of the year. It's a little bit of buyback, but generally speaking, capital continues to form, and that's healthy to position for the risks that are unknown for the next 2 years.
Now, Chris, it's pretty tough to make a case against the money centre banks, obviously, because they're the money centre banks for a reason. But what do you make of the regionals? Because even today, Gorman was suggesting that the worst is over. But is that realistic, considering that we've seen all of this Fed support coming through? We've seen the fact that JP Morgan taking on some of the risk when it comes to First Republic. Should we expect that the worst really is over?
Well, I think in terms of the market being negative about some systemic problem in the bank sector, that definitely feels like that is behind us and in the rearview mirror. From here, I think you have most banks simply resetting their cost of funds and then continuing to build reserves while maintaining profitability. The resilience of the bank engine is very much seen this quarter. So, we feel that while there are risks to a recession, to commercial real estate, most banks have a set of defaults and a set of losses that they'll have over the cycle. The most important thing is to get ahead of it by building reserves. So we saw some reserve building in first quarter, a lot more in the second quarter, and I think that will continue into Q3 while the banks maintain profitability. So the market's looking ahead 6 months, and I think it likes what it sees after these earnings the last few days.